Well, in the last 3 months of 2023, we saw the 4-year swap rate, which is one of the leading indicators of where fixed rates are going in Canada, drop as much as 125 basis points. Now, that's no small change for the average mortgage holder in Canada with a loan of around $300,000, almost $9,000 of potential interest savings on about a 60 basis points mortgage drop. And we've seen that number come down even more in some different situations, which has been a real benefit to a lot of mortgage holders over the Christmas holidays, which has likely been the primary reason we've seen so much more action in Vancouver and Toronto and a lot of other different cities across the country at a time of year when most people are sleeping and lost in the time warp, which is the time between Christmas and New Year's. So let's get into the specifics of what just happened with interest rates and why what happened in the United States as far as employment could have a massive impact on where Canadian mortgage rates go and where they could be going. Welcome to the channel, guys. Alex McFadden here, the owner of Flow Mortgage Co., here to focus on helping you guys create wealth in real estate and keep you up to date on everything that's happening in the mortgage market. If you haven't already done so, hit that like, hit that subscribe. I really appreciate it, and I look forward to giving you some great information today. All right, so let's get right into it. Now, the most recent US data just came out, and Canadian data around employment information. And you might be asking yourself, what the heck does that have to do with mortgage interest rates or money or real estate or investing or anything else? Well, a lot, actually, because what happens as far as employment is concerned has a huge impact on how the economy is doing overall. So let's do a little recap on what actually happened just recently. As of the first week of January, the employment numbers are out, and the United States absolutely blew the numbers out of the water. They came in at a roughly 216,000 jobs created, which is above the 170,000 estimate. And that's interesting news. I mean, first and foremost, a lot more than what was initially anticipated in the overall marketplace. And what's even more so is that wage growth came in hot at 4.1% year over year, which is up from the original amount of 4% and above the comfort zone of 3 to 3.5%, which the Fed in the United States is typically looking for. Meanwhile, what's even more interesting is that here in Canada, we actually saw the employment numbers come in almost at an even 100 jobs added. But if you dig a little deeper, there's actually more to the story itself. Out of those 23,500 new jobs, 23,000 lost. It was 23,000 full-time jobs lost and 23,500 part-time jobs gained approximately. You can double check your numbers. But at the end of the day, what that says is that in Canada, our employment numbers are actually very weak. And so you've got two conflicting parties at play right here, where the US is seeing a bump in employment and of course in wages. In Canada, we've seen a deduction or a reduction in wages due to the fact that people are going part-time or full-time jobs are being lost and no new full-time jobs have been gained. Now, what does this all mean for your mortgage and your interest rates? The first thing is that right on the backs of higher employment, the U.S. Treasury is actually up. Why that matters to you is because the U.S. Treasury and the Canadian 5-year bond yield, which is widely considered the #1 indicator of 5-year and fixed rate mortgages, are very closely tied together. So you can look at a graph and you can see the U.S. Treasury over the last 6 months going up and down, while the Canadian 5-year bond yield has followed. And what actually happened with the employment numbers in the United States coming out has stopped a 6-week rally on the bond from going back down to actually coming right back up and propped the overall bond yields up by about 20 basis points. Now, in the grand scheme of things, fixed interest rates are still down from where they were at the height in October of 2023, and it looks like they've come down. But at this point right now, most of the banks are happy that they've kept that padding and that room in their fixed interest rates, which means they're probably not likely to see the rate specials that we were seeing, crazy enough, over the Christmas holidays. And we've already noticed that some of the discounts that were being provided are no longer in the same category, even though they're still substantially lower than they were before. Now, let's not get too worried here, because at the end of the day, interest rates are still down about 60 basis points from where they were at the height, which represents nearly a 5% increase to borrowing power, and in some cases even more when interest rates are actually being offered at greater discounts. Also, we're just at the very beginning of the potential rate wars in the spring market, where we start to see banks become more competitive. And so for that reason alone, we probably will see interest rates not only stay the same as they are right now, but start to work their way back down in the February and March months. Now, as you could probably imagine, with all the different predictions coming out at the end of last year and more predictions coming out this year, people are continuing to consider revising their numbers and revising their predictions on what's likely to happen. And you've got one side saying we're going to see 75 basis points of cuts, the other side saying none, and the other side saying 1.5%. Nobody's on the exact same page, but nearly everybody is still suggesting rate cuts. There is one common thread around most of the economists that are actually providing projections and predictions right now, which is the fact that they suggest that we're still likely to see a little bit more pain before we get to the point of rate cuts coming in. So when we look at the implied rates of when the cuts are actually going to happen, we're still seeing about 100% probability of a rate cut in April of 2024, but it's been slightly revised down to a 1% cut over the course of the remainder of the year. Again, it's very hard to suggest that we won't see rate cuts in 2024, but looking at this and what's just recently happened, it's a constant reminder of the fact that there will continue to be volatility in the rate market due to the fact that inflation is and continues to be so sticky. Now, virtually everyone outside of a small 15% of economists are still projecting a pretty significant rate drop. And so we do anticipate that will fuel the market towards the rest of the year, which means more interest rate drops on the fixed and the variable rate side. Again, it's probably going to take a little bit more time than we've expected. Now, looking forward into the forward markets again, as to what could actually happen in interest rates over the near future, there is still a projection that we will see interest rates come down about 1.3% on the fixed rate side over the next 18 months, and as much as 2.25 to 2.5% drop over the course of the next 24 to 28 months, which is the forward projection. Now, looking at what that means as far as mortgage costs and what does that mean as far as moving into the new year, there is a lot of concern because there are people coming up for renewal in 2024 and a big chunk of people coming up in 2025. The projection is that most people are actually coming up in 2025, and so it's not likely that it will have immediate impact on the current marketplace for this year, but more so for 25 and even 2026, when all those people who locked in during the pandemic and the following years are actually coming up for the renewal. What's interesting to note is because now we have one less year of people who actually have those low fixed rate mortgages, we're actually starting to see people even start to reach out with 1 or 2 years in who are not as concerned about keeping their mortgages as is and considering making that move that they had talked about before. And this is likely to continue to fuel the market. Among the positivity that interest rates have likely peaked, seeing this happen is another reason that we could start to see a quicker moving real estate market in the early stages of 2024 than what some may have predicted or expected. Now, most of the projections for real estate in 24 continue to be that real estate is going to go up. In fact, I just saw a projection around a 10% growth suggested over the course of the year, which is not nothing when it comes to real estate. Some last interesting tidbits is that there have been reports out recently showing current mortgage balances and overall numbers. And what's interesting is what we've noted that current mortgage sizes are actually coming in at lower numbers than what had been reporting throughout 2023. Now, this might come as no surprise for many because people can qualify for significantly less. And with the higher mortgage interest rates, overall, people can't afford those monthly payments. But overall, it's generally speaking a good sign that the actual mortgage amounts are not significantly increasing, which is keeping loans to value relatively low. And as we anticipate house prices to grow, again, another reason that we could be heading into a more positive real estate market with a more balanced approach than in the past year. So looking forward, how do you actually pick your main product or your mortgage if you're coming up for renewal or you're someone who's looking at buying a property today? Now, if you're looking purely from a projection perspective as to what is most likely to save you the highest amount of money over the course of the next few years, just based on these projections and nothing alone, there are two winners. Number one is the variable rate mortgage product, specifically in a situation where you decide to keep your monthly payments as is, even as the prime rate decides to go back down. And the second product is a 1-year fixed. Now, this is all based on the assumption that interest rates come back down the way that the projections are considering, but they do work out to be the most and the highest cost savings. Now, the reason the variable rate is winning for most products is because they actually have the ability to refinance or restructure at only a 3-month interest cost, whereas if you take a 1-year term, you have to deal with a considerable amount of work in re-signing and renewing and working through that entire process every single year, which can be a headache for some people. So there is a convenience factor associated with that consideration. What's the highest potential outlook cost right now? Not surprisingly, it's the 5-year plus fixed interest rate right now, between the potential of higher rates with rates coming down and the fees associated with exiting a 5-year fixed at 3-year term. It is the product that we are least recommending for most people looking forward. With all that being said, we've got some really interesting information coming up with the Bank of Canada giving their first announcement in the end of January. And while we won't be surprised to see them not make any changes, what we are most interested in is what is it that they actually say and what is the tone that they provide. If you found some value in this conversation today or you have questions, leave some comments below. Love to see them. And if you liked what you had to listen to today or watch this video, make sure to subscribe, check out the podcast, and we'll see you next time.